Have you ever looked at a job offer and seen, stock options listed there? Maybe felt a bit of excitement, but then thought, what actually are these things beyond just like a potential bonus?
Mm-mm. It happens all the time. They're common, but definitely often misunderstood.
Exactly. So today, we're not just scratching the surface, we're going deep on a specific type. Incentive stock options or ISOs. Powerful, maybe a bit complex.
Definitely complex, but potentially very rewarding if you understand them.
Right. So if you want to get how these work and really how they could impact your own finances, well, you're in the right place. Before we dive deeper, though, just a quick reminder, this deep dive is based on material from Farhat lectures.
Oh, yes. Great stuff.
All the content, examples, explanations, it's all derived from the accounting resources over at farhatlectures.com. So whether you're, an accounting student, prepping for the CPA exam, or already a professional.
You should definitely check it out.
For sure. Visit the website for more practice, videos, detailed support on today's topic. And a big thanks to Professor Farhat for providing this material.
And it's really fitting for ISOs. They aren't just any old equity compensation.
Yeah.
They have very specific rules, almost intricate, you could say, especially around qualifying and, crucially, taxes.
Intricate is a good word.
Yeah. And getting those rules right isn't just academic. It can seriously change an individual's financial outcome. And for companies, well, it's a big part of their talent strategy.
Absolutely. So our mission here today is basically to give you that understanding. We'll start with a quick look at stock options generally, then really pull back the curtain on ISOs.
Get into the nitty-gritty.
Yeah, dissect those strict qualification rules, and super importantly, figure out how they're taxed. For the employee getting them and the company giving them out. It's a specific bit of financial strategy, but one that really matters.
Okay, let's do it.
So setting the stage, when we just say stock options, what are we actually talking about, fundamentally?
Well, at its core, it's the company giving an employee the right, not the obligation, but the right to buy company stock later on at a price that's fixed today.
Right. It's not the stock yet, just the option to buy. Okay, let's use an example. Say, Intel. Imagine Intel grants you 1,000 options to buy their stock at $40 a share.
Okay.
Now, here's the catch, maybe. At that moment, the grant date, Intel stock might only be trading at, say, $25 on the market.
So your option price is higher than the market price.
Exactly. So right then, those options are technically out of the money. They don't have immediate cash value because, well, why buy at $40 if you can just get it for $25?
It's really a bet on the future then. You're hoping the price goes up.
Precisely. It's about future growth.
And when we talk about these options, there are a few key terms we probably need to define. The date Intel gives you the options, that's the grant date.
Okay, grant date. Got it.
The $40 price you get to buy at, that's the strike price, or sometimes called the exercise price.
Strike price. Makes sense.
And really critically, most companies don't just hand these over immediately usable. There's usually a vesting period. You might need to, keep working there for, say, 3 years before the options actually mature, and you can use them.
Ah, so it's a way to keep people around, too.
Absolutely. It's a retention tool just as much as it is compensation.
Okay, so you get the options. You wait through this vesting period. Let's stick with the Intel example. 3 years go by, you're fully vested, and maybe Intel's stock has done really well. It's up to $55 a share now.
Ah, now we're talking.
Right. This is where it gets interesting. Your option is now in the money because you have the right to buy at your $40 strike price.
And the market price is $55.
Exactly. So you could buy at $40 and theoretically immediately sell at $55. That $15 difference per share times your 1,000 options, that's your potential gain right there. The day you decide to actually buy the stock using your option, that's the exercise date.
Okay, so we have a sequence. Grant date first.
Yep.
Then the vesting period you have to wait through.
Right.
Then the exercise date, when you actually buy the stock. And then finally, maybe later, the sell date, when you sell the shares you bought.
That makes sense.
And what's really fascinating and kind of the core of our discussion today is what happens tax-wise between that exercise date and the sell date. This is where these incentive stock options, these ISOs, really differ.
Okay, so this is our cue to dive into the qualified category, specifically these incentive stock options, ISOs. You said they're different from non-qualified options. How so?
Well, they come with this whole set of pretty demanding criteria to even be an ISO. But if you meet them, the tax advantages for the employee can be quite significant.
Like a financial obstacle course, you said, with a specific reward.
Sort of, yeah. And the IRS is pretty strict about these rules. First off, the options have to be granted to key employees, and it has to be part of a formal plan the company's shareholders have approved.
Okay, so not just anyone, and it needs official sign-off.
Right, proper governance. Second, the options themselves. They have to be granted within 10 years of that plan being adopted or approved. There's a shelf life for the plan itself.
10 years.
Third, once you get the option, you, the employee,
Right.
also have a time limit. You have to exercise it within 10 years of the grant date. You can't just sit on it forever,
Got it. Use it or lose it within a decade.
pretty much.
Yeah.
And another big one, the employee receiving the option can't own more than 10% of the company's voting stock when the option is granted.
Ah, so these aren't typically for, like, the company founders or major initial investors.
Generally, no. It's aimed at key employees who are crucial but aren't already substantial owners. You can't be over that 10% threshold.
Okay. What else makes an ISO an ISO?
A really important one relates back to your Intel example, the exercise price, that $40 strike price in our example. For an ISO, it must be at least equal to the fair market value of the stock on the grant date.
Wait, so in my example where the strike was $40 but the market was $25, that couldn't have been an ISO.
Correct. An ISO can't be granted in the money. It has to be granted at the money, strike price equals market price, or even out of the money, strike price is higher than market price. The idea is the incentive comes from future growth, not an immediate discount.
That's a key distinction, future appreciation focus.
Exactly. And one last rule to mention. There's an annual limit. An employee can't exercise more than $100,000 worth of these options valued at the grant date in any single calendar year as ISOs. If you exercise more than that $100K limit in a year,
What happens?
the excess amount, anything over $100,000, automatically gets treated as a non-qualified stock option. It loses that special ISO tax status.
Wow, okay. That's quite a list of requirements just to qualify as an ISO. But
Yeah.
let's say you get one and it meets all those criteria. You exercise it. Are you home free then?
Not quite. This is where it gets even more critical for the employee's outcome. Even after you exercise, there are crucial holding period requirements you need to meet for the ISO to deliver those tax benefits.
Ah, the rules that trip people up you mentioned.
Yeah, these are really important. Two conditions, really. First, you have to hold the actual stock you purchased for at least 1 year after the exercise date.
1 year post-exercise.
And second, the sale of that stock must happen at least 2 years after the original grant date.
2 years post-grant. So you're juggling two different timelines?
Exactly. You
Well,
need to satisfy both of those. 1 year from exercise A&D, 2 years from grant.
Okay, so why? Why are these holding periods so vital? What's the payoff?
This is really the core benefit. If you meet both holding periods, then when you finally sell that stock, your profit, the gain, is taxed as a capital gain.
Which is usually taxed at a lower rate than regular income, right?
Typically, yes.
Yeah.
Much lower than ordinary income rates, which is how, your salary or bonuses are usually taxed. But, and this is the kicker, if you fail to meet either of those holding periods, maybe you sell 11 months after exercise or 23 months after grant,
Then what?
then that gain gets reclassified. It's treated as ordinary income, which likely means a much higher tax bill for you.
Ouch. So the timing of your sale dramatically impacts your net profit after tax.
Dramatically. It's really the difference between, strategic wealth accumulation and just paying Uncle Sam a bigger chunk.
Makes sense. And quickly, you also mentioned an employment requirement.
Right. Just to reinforce, these are for employees.
Yeah.
You generally have to remain employed by the company from the grant date all the way up until 3 months before you exercise the option.
3 months before exercise. Okay.
Yeah, though that window extends to 1 year if the reason you left was permanent or total disability.
Got it. Okay, now for the part everyone really cares about, the taxes. How does this all play out on tax returns? Let's break down the journey: grant, exercise, sale for both the employee and the employer, because their experiences are different here.
Very different. Let's start with the employee. The good news for the employee is largely about tax deferral. First, when that stock option is initially granted to you.
The day Intel gave me the 1,000 options in our example.
Right. On that day, you are not taxed. No income recognized, zero tax bill.
Okay, that's good.
Even better, when you exercise the option the day you buy the stock at your strike price, you are also not taxed for regular income tax purposes at that moment.
Wait, really? Even if the stock price is way higher, like our $55 example?
For regular tax, yes. No tax at exercise for an ISO. This is a huge difference compared to non-qualified options, where you often do owe tax at exercise on that bargain element, the difference between strike price and market value.
Okay, so no tax at grant, no regular tax at exercise for ISOs. When do I pay tax?
When you finally sell the stock you've acquired. But first, when you exercise and buy the shares, you establish your adjusted basis. Think of this as your cost for tax purposes. It's basically the exercise price you paid.
So in the Intel example, buying 1,000 shares at $40 means my basis is $40,000.
Exactly. Now, the tax event happens when you sell those shares. And if you've met all those qualification rules, especially the holding periods we just talked about,
1 year post-exercise, 2 years post-grant.
then your gain, selling price minus your adjusted basis, is treated as a capital gain. Or, if the stock went down, a capital loss. And again, capital gains usually mean a lower tax rate.
But if I didn't meet the holding periods.
Then, as we said, that gain gets treated as ordinary income. Higher tax rate.
Yeah.
Much less favorable.
Okay. And what if the stock never goes up? What if it stays below my strike price and I just let the option expire after 10 years?
Good question. If the option lapse is worthless, you can't claim a loss. The reasoning is you never recognize any income when you received it, so there's no corresponding loss to claim if it expires unused.
Okay, that makes sense. So the employee gets this potential for great tax treatment, but it's conditional on following all the rules. What about the company? What's the flip side for the employer granting these ISOs? Do they get a tax break?
Here's the major trade-off for the company. From a tax perspective, ISOs are not considered a compensation expense for the employer, meaning the company gets no tax deduction for granting ISOs. Even though they're providing something valuable to the employee, they can't deduct that value from their own corporate income taxes.
No deduction at all. That seems significant.
It is. And it's a key reason why companies weigh the pros and cons. With non-qualified stock options, the company does generally get a tax deduction when the employee recognizes income. So offering ISOs is a deliberate choice to give the employee the better potential tax outcome, even at the cost of the company's own tax deduction.
That really highlights the strategic element. Okay, to make this all less theoretical, let's walk through that John example from the source material. I think that will help solidify everything.
Great idea. Examples make it much clearer.
Okay, so we have John. He received an ISO on March 15th, year 1. This option lets him buy 200 shares at an exercise price of $100 per share.
Okay.
And critically, on that same day, March 15th, year 1, the fair market value of the stock was also $100.
Oh, perfect. That satisfies the rule.
Yeah.
Exercise price is at least equal to fair market value at grant. So it starts out as a qualified ISO.
Right, so let's follow John's timeline. Fast forward to April 3rd, year 2. The stock's value has gone up. It's now $120 per share. John decides, okay, time to exercise.
Good move. It's in the money.
He buys his 200 shares, paying the $100 exercise price. So his cost, his adjusted basis is what, 200 shares times $100?
That's $20,000. His basis is $20,000.
Okay. Now, John holds on to these shares for a while. Then on May 10th, year 3, he decides to sell. And the prices climbed even higher. He sells them for $180 per share.
Wow, good timing for John.
Mm-hmm.
So his total proceeds from the sale would be 200 shares times $180.
Just $36,000.
Like $36,000 selling price.
Okay, so based on everything we've learned about ISOs, did John owe any tax back on March 15th, year 1 when he got the option?
Nope. No tax at grant for an ISO.
What about on April 3rd, year 2, when he exercised and bought the shares for $100, even though they were worth $120? Any regular tax then?
No regular tax at exercise for an ISO. That $20 per share difference wasn't taxed then.
Okay, so the only potential tax event is when he sold on May 10th, year 3. What happened then? Did he meet the holding periods?
Let's check. He exercised on April 3rd, year 2, and sold on May 10th, year 3. That's more than 1 year. So check 1.
Okay, 1 year post-exercise met. What about the other one?
He was granted the option on March 15th, year 1, and sold on May 10th, year 3. That's well over 2 years. Check 2.
So he met both holding periods.
He did, which means...
Capital gains treatment.
Exactly. The entire gain is a capital gain. We calculate it as his selling price, $36,000, minus his adjusted basis, $20,000.
Which gives us a $16,000 gain.
$16,000 taxed as a capital gain, likely at a much lower rate than if it had been ordinary income. That's the ISO benefit, perfectly illustrated for John.
Fantastic outcome for John. Now, what about his employer? Did they get to deduct anything related to this $16,000 gain John realized?
No, they didn't. Remember, ISOs don't generate a tax deduction for the company. So while John got the favorable tax treatment, the company got no corresponding tax break. It really shows that strategic choice in action.
Right.
Okay, let's try to pull all these threads together then. This deep dive into incentive stock options really shows they can be this powerful tool, right? helping employees potentially turn compensation into capital gains, which are taxed lower.
Huge potential, yes, but it's not automatic.
Definitely not. It all hinges on meeting that strict list of qualification rules up front and then, critically, sticking to those holding periods. The 1 year after exercise, the 2 years after grant.
Get the timing wrong and poof, that benefit can disappear.
And for the companies offering them, it's this interesting trade-off. They give employees a really attractive incentive, maybe helps with retention of key people.
But they give up that corporate tax deduction they might get with other types of stock compensation.
So if we zoom out a bit, think bigger picture. These kinds of detailed compensation structures, like ISOs, they're clearly not just about paying people. They shape behavior, don't they? Oh, absolutely. They create specific incentives for employees to hold the stock longer, stay with the company, and they reflect the company's strategy, who they want to reward, how they manage their own tax position.
It really impacts everything from employee motivation and retention to maybe even how wealth gets built up over the long term for those key employees.
For sure. And understanding these nuances is so important, whether you're the employee receiving them or involved in designing these plans.
Yeah, hopefully this dive encourages you, the listener, to maybe look at any equity compensation you see with a bit more insight. Or think about how these rules could play into your own financial planning. It's definitely way more valuable than just knowing the term stock option.
The details matter immensely here.
So maybe a final thought to leave everyone with. Given this trade-off, the employee benefit versus the lack of company deduction, how do companies really make that call? How do they balance trying to incentivize people effectively with their own tax situation when they design these plans?
That's the million-dollar question, isn't it? It involves finance, HR, legal, weighing the competitive landscape, the company's stage of growth, its tax profile.
It really highlights the strategic complexity behind something that just looks like a line item on a compensation statement. What stands out to you about those choices involved in offering an ISO versus, say, a non-qualified option?
I think it often signals a company's belief in its long-term stock appreciation and its desire to align key employees with that long-term view, even at the cost of a near-term tax deduction. It's a statement.
A powerful statement. Well, as always, remember that understanding this stuff is the first step, but applying it is where the real value lies.
Keep digging. Stay curious. Financial literacy really does pay off.